Hello, welcome back. So, Digital Turbine had its earnings report and the stock is down significantly, about 24%. Now, it's currently sitting at $12, 12.4 right now as I'm making this video. Yet at some point it has been about 9, like a couple of months ago or so. So, it is interesting to notice that there was an even better opportunity to buy this one. But is it still a good opportunity is what we kind of want to see. The first thing that I want to examine is take a little bit of a look at the max chart, and you can kind of see the story of the company, which has been trading on a base for a long while, as you'll see here, pretty much trading sideways, as we like to say, or at least sideways compared to what happened later. And then it actually had a boom and went to like 90, which was significantly overpriced, and then it started dropping again, getting back to normalcy. And it's down about 78% since its 1 year high of about $55 over here. Now, we're going to examine the financials of the company, but before we do that, let's take a look at what happened with the earnings report. Because you will see that the company lags Q3 earnings and revenue estimates here. So, what happened? They did post quarterly earnings of 29 cents a share, missing the consensus estimate of Zacks, that is, of 37 cents a share. So, this is a pretty significant decline here, which is an earnings surprise of about 21%, as you'll see. And this compares to earnings of about 49 cents a share a year ago. Now, this has been dropping precipitously, as you can see here. It makes a ton of sense. Advertising has fallen off a cliff for many companies, including Google, for example. Like YouTube, we know that advertising has been going down, the money that they are generating, the revenue. And the same thing for Meta, for instance, or Amazon. So all of these companies have been suffering from advertising, although I think Amazon was doing a little bit better, mainly because of the fact that advertising is integral to actually selling on Amazon. So, over the last 4 quarters, the company has surpassed consensus EPS estimates 2 times. So the company is still doing well and they're still making money. We're going to examine the financials because they matter a ton, of course. But it's important to notice that this could potentially show itself as an interesting opportunity for buying a company of this sort. But is it really? Let's examine the financials. Now, 21 is the PE, 22 almost over here, and the price to free cash flow about 20. So it's borderline where we want it to be at least, and anything lower than that is fine. Now this becomes green when it's below 20, but still, when it's somewhat near 20, it becomes very, very interesting. And you can kind of see the decline here. It has been getting better and better in terms of the PE ratio and the price to free cash flow ratio, indicating that the company is getting cheaper and cheaper, obviously because the stock price has been going down. But remember, it was 9 at some point, so this was even better. Now, the outstanding shares have been increasing because the company has been selling a ton of shares. Makes a ton of sense as well because the stock has been on a massive uprise over here. And so it makes a ton of sense for a board to actually be selling the stock and making money, making capital while the stock is in an upwards movement. And so this is why they issued more and more shares. Now, the company has a ton of liabilities here compared to the free cash flow that they generate. However, they have amazing key metrics, like they have been growing at a tremendous pace, as you'll see here. Their net income growth has been tremendous, the free cash flow growth tremendous as well. Pretty much everything. All their numbers over here are pretty nice to see. The interesting thing to notice is that the net income margin is actually 13%, and it hasn't been going that much higher than that, as you'll see, sitting a little bit lower than 20 over here. And this is probably too little for a company of this sort, like an advertising company. It kind of indicates that they're spending a ton on acquiring customers. But it makes a ton of sense for a company of this sort because it's growing. And so you can expect this kind of margins. And even 13% could be a pretty neat margin for a company that will be spending a ton to actually grab new customers. So this is not looking bad at all over here. And what about the actual financial statements? What is going on over here? A company that has grown its revenue like a tenfold almost, from 74 million to 747 million. This is fantastic. This is a great revenue growth, as you can understand. Fantastic to see. And what about their net income? Again, growing from losing money to making money, which is exactly what you want to see for a company of this sort. And even though it has been on a decline, a significant decline, the stock price that is, it has been increasing their net income. The reason why it has been on a decline is because it used to be super expensive. As we examined earlier, just by looking at the PE, you could tell it was like 140 at some point. So the balance sheet of the company, again, you can kind of see that the total equity of the company has been growing from 27 million to 500, almost half a billion. And this has a lot to do with the additional operating capital, of course, the company issuing shares. But also, again, remember they are net income positive. You can kind of see it here in the cash flow statement. Net income has been positive for pretty much the last three fiscal years. And if you take it to operating cash flow, also positive over here. And again, when you account for the capital expenditures, which are not too many for a company of this sort, you are taking it to about 60 million in free cash flow right now. So free cash flow positive, net income positive, good thing to see from the company. But is it cheap enough to buy is the question. Is this a good price? About $12, 12.5 is what we need to be asking ourselves. And the way to see that, oops, I clicked the wrong link over here, is to take a look at our discounted cash flow model. So let's take a look at that. Remember that any one of our patrons has full access to this tool over here, and you can become a patron by visiting the links that you can see on the bottom of this video, the description. And so the revenue of the company again has been great, and the average has been about 63% in the past 5 years. Now we have to use something that's significantly lower because we are projecting for the next 5 years, and we can say something like 10, 12, and 14, or maybe 15, and see 10, 13, and 15, and see where the company takes us to with this kind of revenue growth. Now, the net income margins of the company have been at about, I'd say the average, you can kind of see here, that has been dropping a little bit, but the average in the past few quarters, the average I think should be about 10 to 13%. I'm going to try a few numbers here, 10, 13, and 16, and see how this affects our projections. Now, the free cash flow margin, again, a little bit all over the place. On average, probably something like 100% does make sense. I'm going to go a little bit lower, 80, 90, and 100, the kind of typical that I like to use, and it's very standard for most companies. And the 13% is the amount of money that I typically want to be making annually from any single stocks. Now, we hit calculate, and what are we getting here from Digital Turbine? Is it cheap enough? Now, the low value that we're getting is $12, and again, currently we're sitting at 12.4, so we're very, very close to this one. The medium is 20, and the high is 30, with the current price being at $12. But remember, it used to be 9, so it would have been a much, much better opportunity then. But even now, it's not that expensive, as you'll see. Now, it does change a lot because I have used very, very different values here in terms of revenue growth, net income margins, and free cash flow margins. And especially the net income margins obviously affected a lot. We're getting much, much higher money for our buck. And also the revenue is increasing pretty much the cash flow that the company generates in the next 5 years. But it does make some sense to be potentially adding some of this company to a portfolio. It is a company that is cheap enough to be an interesting hold for a portfolio for the long run. And again, this precipitous decline that they have been having could be an interesting opportunity for adding this one. I kind of want to take a little bit of a look at our insider trades module here for Digital Turbine. You can kind of see that these are pretty much like awards and in-kind sales. These are pretty much expected sales. It's not something out of the ordinary that you are seeing here. And you can kind of see it here in our pretty much in the tool representation, where it tells you what kind of transaction type you are looking at here. But the most important things that you typically like to see is the buys. Like, is somebody buying over here, or is somebody selling too many shares? So yeah, what you kind of, and especially somebody important has to do with the economics of the company, like the CFO, for instance. So what you can kind of do is use our search tab and go like CFO and see what kind of sales the CFO made. So did they actually sell too many stocks compared to what they have? And as you'll see, they are owning way too many shares than the ones that they are selling here. They're selling very small lots, apart maybe from this one, which would happen once in a while. But overall, they have been holding a ton of shares and not really selling too much lately. Again, as you will see, you can kind of see the dates and everything. Garrison Barrett, the CFO, hasn't been selling that much, which is, generally speaking, a good sign for a company. And also the better sign is to see somebody buying, but there haven't been any buys here. But it's still interesting to see what is happening with the company. And the other thing that I kind of wanted to take a little bit of a look here is what the analysts are saying for the price targets. And you can kind of see that there is a little bit of a standard pricing, like Oppenheimer here. As you'll see, where did I see that? Oppenheimer, for instance, Roth Capital, Macquarie, they are all saying something like 40 makes sense for Digital Turbine, which is pretty much about doubling the current price. And if not more, because when this was posted, it was $20, for instance. So it's interesting to notice what they have been saying, just to take a little bit of a look at the analysts, or some analysts at least. And yeah, it is a company that I think is interesting, and again, could be a nice hold for a portfolio. It's not that expensive. It used to be cheaper, but still at this pricing, based on what the company has been achieving lately, seems like an interesting potential addition to a portfolio. Now, you have to bear in mind that in this current economy, maybe advertising will suffer for a little while, so this is important. But again, if you are somebody who is aiming to add companies for the long run, basically a long-term investor, this may actually be one that, if you size properly, don't overdo it, of course, it may be an interesting an interesting little addition to the portfolio. Thanks for watching the video, guys. Do tell me what you think about Digital Turbine. Leave a comment below. I'm interested to hear your opinion. And remember again to leave a like. That helps a ton. And of course, if you are new around here, subscribe. And I'll see you in the next video. Bye-bye for now.